Okay, so chapter 13, I think it's maybe the hardest chapter that we're going to cover, um, because the equity section, as we know from the accounting equation, all the action is happening in the equity section, right? In terms of the movement within the business, what it's actually operating and trying to achieve, right? We have assets, oh wow, like that. Assets equals liabilities plus equity. But within this section, we have all this stuff, contributed capital, retained earnings, and within retained earnings, it's all the operations of the business. All the revenues and expenses are kind of contained in here. So there's a lot of stuff, a lot of complexity happening here. Okay. And so this chapter, we're now going to look a little more closely as what's happening in that equity section of the balance sheet. Okay. So um, we'll start off with a little review. Uh, the characteristics of a corporation. This is covered, I think, in chapter 1. So we'll revisit that, make sure we're clear on that background. Because you don't have, without corporations, you don't have stock, okay? This whole idea of stock ownership and fractional ownership of a business is based on this idea of a corporation. Okay, so this legal framework that we have to form business entities in, most of the world now. This system exists pretty much everywhere, but it didn't always exist like that. And so I think we should be very clear about what it is and why it's kind of a technology. It is a technology. It's a financial technology, but it is a way of organizing an economy. Okay, so we'll talk about that, review that. Um, Issuance of stock. So there's a little extra detail because again, this is probably the first journal entry we did, right? First transaction, issue shares worth 20,000 to raise capital, right? That was like the first journal entry we did. So there's a little bit of extra detail we'll talk about. Um, Treasury stock, okay, this topic, when we hear about stock buybacks, a company buying its own stock back from the market, we'll talk about how to account for that, why companies even do it, what is the advantages. Um, so we'll talk about those. Dividends, okay, so again, cash dividends, this is something we've seen since the second chapter, but we'll again talk about more details. There's certain specific events that happen in the declaration of dividends and the paying them. There's also different types of dividends. So there's stock dividends. So we'll talk about what that is, how to account for that, and then stock split. And then these two are kind of related. So we'll talk about the difference. Um, we'll look at an income statement that shows the earnings per share. They actually all do, but we'll just talk point that out, emphasize that, uh, understand what earnings per share is and why it's an important metric. It's probably in some respects more important than the revenue for the whole company. Okay, because an investor, yes, they care about the overall business, but they also really care about the value of their shares. Okay, so the per share metrics are going to matter a lot for that. Okay, we'll again just revisit the equity section of the balance sheet and see how all this stuff that we've talked about ties into that. And then, yeah, we'll just talk about these different metrics: earnings per share, rate of return, return on equity, as it's also just in short form called rate of return on common stockholders' equity, also called return on equity. The price to earnings ratio. So we'll talk about these at the end of the chapter. Okay. So just a review of corporate entity. So what are the major characteristics? Number one, it is a separate legal entity. Okay. So just like a person, it can own property. It can break the law. Usually, now there's since 2000, Sarbanes-Oxley, I think it was 2003 or something. The CEO, actual people can go to jail, but also companies can commit crimes. Um, but again, the big thing is owning property, being able to conduct business just like a person. Okay, but the person, the shareholders, the owners of this corporation aren't personally liable for anything. Okay, so this corporation is a separate person. You can think about it like that. But unlike a person, a corporation can live forever. Um, it it has no physical form. It's like a legal thing, but um, from a legal perspective, it has many of the same rights as a person does. Secondly, you can have many shareholders. Okay, uh, there could be thousands or millions of shareholders for a corporation. Other simpler forms of business don't accommodate that. There's like sole proprietorships where there's only one owner. Partnerships are typically limited in the number of partners there are. But a corporation, a key factor is that the shareholders are numerous and they don't necessarily need to know each other or have any affiliation with each other. Yet they're all still connected through their joint ownership of the business. Um, no personal liability. This is a big one, okay? Because shareholders, they're more likely to take a risk on a business if they know exactly how much they can lose. If you're investing in a business and not only will you lose, like, let's say the $100,000 you invest, but they could come after all your other assets, you may be reluctant to invest. Okay, so the fact that your loss in your investment is limited to how much capital you've put up and nothing more than that, it encourages people to take more risk. Okay, so this is a key feature. Uh, there were times where even your family members, okay, this is like a very un-American thing, but there are some advantages we could even talk about where, let's say your brother took out a loan and didn't pay it back. The moneylender could come after your whole family for the money. Okay, so uh, that that not only are you limiting your liability, or like there's infinite liability for you, but also your family. You got to like watch out for what they're doing. Okay, so uh, this is a big innovation in risk taking. Okay, um, to have this limited liability, it's not just a trivial thing. Um, Lack of mutual agency. So basically, if you're an investor, if I own one share in Tesla, I can't go to some, warehouse and be like, "Hey, I'm the owner of Tesla. I can let me sign a lease on Tesla's behalf to lease this warehouse." Okay, only the managers who are delegated those responsibilities on behalf of Tesla are able to do that. So even if you own 50% of the company, if you're not a manager, if you're not um, part of that organization that's in like given those abilities to bind the company, you can't do it. Okay, so that also protects the business, it protects the shareholder, because if you're a shareholder and there's some other shareholder that's like reckless, that shareholder can't just do whatever they want with the business. It's only whoever is actually managing the business and has been deputized with those responsibilities. They're the only ones that are able to bind the business. Okay, but this is different. A partnership, one partner can bind the whole partnership to something. Okay, so again, these features are very important in why a corporation is like the de facto entity that businesses kind of operate under. Okay, I mentioned this indefinite life. So the corporation can outlive even the founder, right? JD Rockefeller, he founded Standard Oil, is first like mega corporation in America, you can argue. Um, and it continues to live. The shareholders, there's no Standard Oil anymore, but pretty much Chevron, ExxonMobil, these are all spin-offs from Standard Oil, okay, because it had a monopoly and they were forced to split apart. But if you own shares in Standard Oil, I bet, I'd have to verify this. You could fact check me, but you probably would still own the corporations that are around. Like you'd own some Chevron, some Exxon, some whatever. There's some other oil companies that are spun off from that. So your ownership would have been split. So, but it would continue to live. Okay. There are some corporations that have been around for hundreds of years, and some of them are probably privately owned, but the shareholders still, they still retain ownership in this valuable entity, and their heirs get it. You can pass on your ownership to your heirs. Um, Taxation. So one disadvantage for large corporations is that the corporation, because it's like a person, pays tax, but then you as a shareholder are also going to pay tax. In which ways? Well, if the corporation pays you a dividend, right, that is cash that is available for the business, but it's from, hopefully profit that the company's made and they've paid tax. So that dividend is like a post-tax distribution. Okay. So the corporation pays tax, they give you a dividend, but you're as an individual going to pay extra tax on that dividend you receive. So this is a big disadvantage for American corporations. There are some countries that don't have this, that they understand that the corporation was taxed, and so the individual should be able to get their distributions tax free. But in America, um, it's taxed, the dividends. Also, if you own shares, and you sell the shares for more than what you bought it for, you will pay capital gains. Okay, so there's a lot of criticism for, like, the billionaires, right? Bezos, okay, for example, he has many billion-dollar net worth, but it's all in this stock, and he's only going to pay tax on it if he sells those shares. In which case he'll pay size, a large amount, but he's just not a seller, so he doesn't have to pay tax on it. Um, and Amazon, I don't think, pays a dividend, so he's not paying tax. His business has paid a ton of tax. They paid corporate tax, property tax, payroll tax. It's not like Bezos isn't getting hit with the tax bill somehow. It's just his shares, his ownership in the equity interest of the business is not being taxed. Okay, so this is uh, a key thing to understand. Without him, Amazon wouldn't exist. All the taxes that come from all the employees, all that wouldn't be there. So I think we have to be a little nuanced in our understanding of corporate tax and the taxing of very wealthy people. Okay, it's not as straightforward as maybe politicians and journalists want to make it. I'm not saying that, I'm not trying to defend, but I don't think that if you just watch media and like listen to politicians, you're not getting the full picture. So hopefully you're now going to understand something about business and business entities and understand that actually they do pay a lot of tax. Um, Maybe if we have time, Bill Maher, who's he has like a talk show, he had a good take on taxes recently, which I think would be, maybe I'll send it to you guys later. But um, okay, so any questions on taxation or anything I've talked about? I guess let's just cover this last one. Capital accumulation. As we see, a business corporate entity has retained earnings. So whatever profits it's earned, yes, it does pay tax, but it's able to retain all that capital and then reinvest it in growth. Okay, this is kind of like what you could argue this is a key form of like the capitalist economy or capitalist mindset. If you're given $1 million, most people are not going to say, well, I'll distribute it to my friends and family or give it away or whatever. They'll probably be like, I'm going to save it or I'm going to invest it, right? That answer is coming from a mind that has grown up in a system of economics where this capital accumulation happens. When you invest your money and you get interest, that interest is not just coming from some tree, right? Some magic money tree. It's coming from business growth. It's coming from these companies creating value, creating new products, expanding into new markets. Um, it's all coming from this capital accumulation. Okay, so we are all participants in this. Our 401ks, our pension funds, our savings. When we put money in a bank, the bank is lending money. It's all fueling this system, and we have such a high standard of living because of it. And of course, it has downsides a lot, but it also has tremendous benefits that we're all kind of benefiting from. Okay. All right. So disadvantages, uh, ownership and management are often separated. So the the principal agent problem. Okay. This is a huge problem in economics where the person that owns is different than the person that manages. Or the person that's representing you has different interests than yours, right? Like a sports agent, for example. A sports agent represents an athlete. The sports agent is compensated on percentage of the contract or whatever, right? So that's not always fully aligned with the athlete. What if if you're some athlete and I don't know, OnlyFans wants to sponsor you, okay? Maybe they're going to pay you a lot of money, but your brand is maybe not is going to get hit, you know? Maybe you as an athlete don't want to do that because it's like, it's like it's like kind of a seedy company. But your agent might be like, well, they're getting 10% of that, so they may push you to do that, right? So this is a classic problem. I don't know if it's in this class, someone said, well, aren't there corporate laws about corporations have to maximize profit? And that's like a bad thing. It's largely a protection against principal agent problem where the managers of a business may have other interests that diverge from the shareholder. Maybe they want to promote themselves. Like you see Elon Musk, he happens to be the controlling shareholder and the CEO of Tesla. But he does a lot of self-promotion stuff with his companies, and that could be to the detriment of the shareholders. So what those corporate profit maximization rules are is to not allow the agents of the business to screw over the shareholders. Okay. So, so that's one big problem. Double taxation, we talked about that. Um, Government regulation of corporations. So it just costs money to run your corporation. You got to pay various regulatory things. You got to there's certain rules of managing the corporation, operating it that you got to pay for. And then there's startup costs. So when you first incorporate, there's going to be some expense and time that goes into that. Okay. All right. Any questions on this? This is like it's very important to understand both the pros and the cons of this. This is what our whole economy is built on, these corporations. And you may start one too, right? The startups in Silicon Valley, they're all, if they're taking venture capital, they're all incorporated as Delaware S corporations or C corporations. Okay. And that allows them to take in capital, right? It can bring in new shareholders. Um, Delaware has a very uh, developed legal structure for resolving any corporate disputes. That's why it's the state that's preferred for a lot of corporations. Um, so understanding this stuff is important in your business kind of general knowledge. Okay, so if you have any questions, ask them now or anything unclear. Do you have questions, Scott? I kind of missed that last bit of it, of what you said. Did you hear all these disadvantages? You caught that? Yeah, I see it. Okay. Yeah, I was just saying, not only are the big corporations that we think about corporations, but even small startups, they're corporations too. So this structure of business using a corporation is prevalent through all levels of our economy. That's basically what I said. Yeah. Okay. Um, okay. So how is equity ownership partitioned? Well, as we know, a company issues, or you can think of it as creates shares. Okay. So those shares represent some participation in the business. And in exchange for participation in the business, investors will give uh, capital, and it's usually in the form of cash. Okay, so that's like those are the two parts of the transaction: issuing the shares to the investor, and the investor giving the company cash. Okay, and so we've seen that again since chapter 2. And the shares represent some fractional ownership in the business. So the different forms that we see in our common stock, we're going to talk about this preferred stock. I think we've mentioned it, but we'll just review. RSUs, so this is restricted stock units. This is basically compensation to employees. It's given in the form of, now it's much more common um, than stock options. Stock options were kind of like how it was done maybe 20 years ago, but now RSUs are kind of the more common way that employees who work for a company, instead of giving them cash compensation, the company's giving them stock. Okay. Now, why would a company do that? Why would an employee want that? And why does the company do that? Is someone winning, or are they both winning in this? Both? Why are they both winning?
First, because the employee gonna feel the ownership of the company for more,
Okay.
and employee gonna win because if the company does good, the shares increase in price, and eventually they can sell it and benefit actually getting cash out of it.
Okay. And how does the employer benefit?
Well, if the employee works better, having like that motivation as an owner,
Yes.
then the productivity goes up, and that's how employer benefits.
True. I agree. So the stock-based compensation is a way to try to mitigate this principal agent problem, right? By making the agent, who's the employee, also a principal, meaning an owner in the business, you're trying to create a alignment of incentives. So yes, you're right. Okay. Uh, there's one other big benefit to the employer that Margarita did not mention.
Yeah.
Yeah, yes. Okay, Tyler, do you have? Yeah, that's true. Usually the company will not give them all the shares up front. There's a vesting schedule, usually over 4 years. So you have to stay to get all the shares. And they keep giving you more. Every year they'll give you a little more to try to keep you there for longer. But yes, Marguerite, you said something important. Cash. What did you mean?
Because if they want to compensate the employee, they have two options. One is giving them cash, and the other is stock option.
Exactly.
So giving cash in the retained earnings benefits company a lot.
Yes, it's a way to conserve the company's cash too. Okay. Um, the the company, oftentimes, especially for startups, okay, you can think about Mark Zuckerberg. Who's seen that movie Social Network? No, it's really good. Okay, at the beginning when they first start, what is the only thing he has to offer his buddies in the dorm to join the company? Equity, right? He can only offer them equity because the company has no cash, right? So in order to get his buddies to work for him, he gave them some equity in the company. Okay, because literally he had zero cash. So it wasn't even about conserving the little cash. He just didn't have any. Okay, so yes, especially for startups when cash is very scarce and there's many uses for the cash, um, you're gonna try to conserve that cash for some entity that, like, uh, whoever will take the stock, you'll give it to compensate at the beginning. Okay, because that currency you can create out of thin air. You can't create cash out of thin air. Okay, so like for Facebook, they maybe needed servers, right? The server store is not going to take Facebook stock, right? They're going to only take cash. So that cash that they have, they want to conserve for those purposes. Okay, but again, the employees also benefit because if the company does well, they're going to make a lot. Um, there's a famous story of the graffiti artist who made the first mural at Facebook's like first headquarters. Does anyone know about this? David Cho. David Cho is like this very like at the time. I don't think he was like super famous, but he's a graffiti. He's like an artist basically. And at Facebook's first office in Palo Alto, they wanted some art, so they paid him, and they're like, "We'll either give you $10,000 cash or stock in Facebook." And I've listened to some podcasts. He's a very interesting guy, but he's basically he didn't have the foresight. He's just like, I'm a degenerate gambler. Okay, he's like a gambling gambler. So he's like, I'll take the stock." Okay, and that stock turned out to be worth like 100+ million dollars because this was like so early in Facebook's life. Um, so it paid off. His gambling paid off. Um, but for if Facebook knew they were going to be successful, they would have been better off paying him $10,000 of cash, right? But again, when there's a lot of uncertainty in the business and it's first starting out, uh, it's probably a good trade to give stock up because most companies fail, So if you can get that graffiti art you know, for these shares, maybe you got it for free because the company goes to zero eventually, okay, which is much more common. Um, but again, if it does really well, you're gonna do well too. Okay, so everyone good on this? Like common stock, there's also different classes. I think we've talked about this. You can have, and we'll talk about in the next slide the different rights that are available to the shareholders. So they can be differentiated, but these are kind of the major types of stock that are issued. Now, you can see in this diagram here, we have three concentric circles, okay? And the way that the stock is organized is that on this outer one, this is the total amount of stock that's authorized, okay? So when you first incorporate your company, you're going to say there's 10 million shares that are authorized to be issued, okay? It's the total maximum number, okay? The next one here is how many you actually issue. So if you started off with 10 million authorized, maybe you're going to only issue a million to start with and distribute that amongst your shareholders. So if there were a million, if there were 10 million authorized, 1 million issued, okay? Let's say you had 150,000 shares. What percent of the company do you own? Assuming they're all like kind of uh, pro rata, meaning divided up equally. What percent of the company will you own if you had 150,000? What do you think? Is it going to be 150,000 divided by 10 million or 1 million? 1 million. Yes. The issued is what really this authorized is the total hypothetical number. It's arbitrary. What really matters is the issued. And really what really matters is the outstanding. And how does something go from issued to outstanding? Because the company can buy back its own stock and cancel shares that they've already issued. Okay, so if they issued a million and they bought back 100,000, there's only 900,000 that are issued and outstanding because the 100,000 were kind of bought back by the company and taken out of circulation amongst owners. That makes sense? Yeah.
And you said cancel. Do you mean retire or just?
Yes. So there's two options. So when a company buys its stock back, it can keep them and then maybe at some certain point resell them, or it can just cancel them.
So if they are retired, the number of issued.
Yeah, that's true. That's a good technical question. What happens when they retire it? Yeah, during the break, let's talk to Gemini. We can ask and see what happens. Now, I don't know the answer to that. Yeah. Um, but yeah, I just know that you can either retain the stock and then have the opportunity to resell it later, which we're actually going to learn about. That's like one of the big parts of the chapter. Or you could just cancel the shares. In which case, yeah, there's probably we'll see. We'll see what the AI tells us. Okay, any questions on this? The difference between these three? Authorized, issued, and outstanding. Is everyone very clear on the difference? Yeah. Okay. Okay. So the voting are the different rights that equity owners have. Okay. The number one is voting. So um, basically, for major decisions, and really the most major that the shareholders decide is who is on the board of directors. Okay. So we talked about the structure of a corporation where you have shareholders, they elect a board of directors who represent them. The board of directors are then in charge of selecting the CEO, the CFO, all the corporate managers. Oftentimes, the CEO and the CFO or corporate managers can be on the board too. That can happen, but the shareholders and then can vote them all out. Okay, they're the ones kind of determining who's on the board. Um, And then, if there's a merger, right, the shareholders have to approve of that. So there's certain large events that the shareholders will vote on. Okay. But the day-to-day operations is managed by the board of directors, who are, of course, chosen by the shareholders. And the voting is proportionate to the number of shares you own. It's not equal. It is unequal, but it's fair in the sense that if you own more shares, you get more say in the company, and it's kind of a logical system. Now, it's not always, as I mentioned in like Meta, uh, Mark Zuckerberg, though he has shared economic interest, meaning the you can say think of it as this next one, dividends. He gets like a proportionate share of the economics of the business. His voting rights for his class of stock is like 10x. So he still effectively controls Facebook just because he has that special voting class. Okay, even though I think he only owns like 15% of the business. Okay, he can basically veto anything because he can outvote everybody. And you, as an investor in Facebook, when you buy shares, you are uh, kind of agreeing to that structure. You're allowing Mark Zuckerberg to kind of control the company on your behalf. Okay, so that's the trade-off that the shareholders of Meta are kind of engaging in. Okay, so dividends. You can think of this as economics. Okay, you have some economic interest in the business. Okay, so usually you can think about it as this is control and this is economics. So if you ever have a startup, these are the two major classes of items you will need to negotiate with your investors. Who has control and how are the economics split? And they're two separate things. As we saw, you can have all the control, but like kind of share in the economics pro rata, or you can give up control and make both of them proportionate. So these things are negotiable and they're separate topics to be negotiated. Okay. Um, this liquidation preference is part of economics. Okay, so a venture capitalist, they're gonna want when they put in money, they're gonna want if things go badly, they want to have their money be able to come out first before the owner or the founder gets any money because the founder is necessarily not put up anything, okay, of actual dollars. So if the company goes bad, this liquidation preference allows the money investors to be the first to get their money out. Okay. So it's kind of related to the economics of the dividends, but it's a preferential treatment. Okay. Um, so maybe if we have time, I can show you, we can look at some numbers of how this works. But it's an important thing to negotiate. And VCs will always have a liquidation preference because they don't they if things go well, they're going to share the economics with the founder. If things go badly, they're going to get their money back first. Okay, and this liquidation preference allows that. Um, Preemptive rights. So again, this is like uh, in the story of Facebook, Eduardo Saverin, his buddy who invested the first money into Facebook, he owned like 30% of the business. He didn't have preemptive rights, or I mean, I guess like whatever. He got screwed over because when they eventually brought in venture capitalists. The venture capital was like, this guy shouldn't have 30% of the business. So they set it up so he was diluted. His interest was going to get reduced from 30% because he didn't have preemptive rights, meaning he couldn't invest to maintain his 30% interest. Okay, so it's a way, again, if you, as you're taking on more capital to maintain your percentage, uh, you're given a right to do that. Okay, you don't have to, but you're at least given the right. So he didn't have that, and he got in a big lawsuit. He never signed the documents, I think, for taking on that venture capital, but Zuckerberg just continued to do it, and they litigated and they settled, and I think he got a couple $1 billion from the settlement. Okay, and again, the different classes and types of stock, you are going to mix and match all these different rights. Um, But typically, the common stock that you buy, you're going to have proportionate voting, dividends. This is only really relevant for like venture capital and certain special situations. Preemptive rights. This one, yeah, I don't know. I'd have to see. I don't actually know the answer. I don't think so, because when you own stock in a just some regular company, they don't ask you every time they're going to issue new shares whether you want to participate. So I don't think that this is really. This is also kind of probably for private companies and venture capital and stuff. Okay. Um, okay. Any questions on these rights? What they are? Anyone need any clarification? Okay. Okay. So this is Amazon's section of equity, and they're on their what financial statement is this found on? Who votes? It's on the balance sheet. Who votes? It's on the income statement. No, it's balance. What is the balance sheet? Assets equals liabilities plus equity. This is basically the equity section. So yes, it's from the balance sheet. Okay, so um, you can see a little more detail. Okay, it's this par value. Okay, we're going to talk about what that is. Okay. Um, how many? This is in millions, so it's I think no, it's yeah, it's got to be yeah, it's in millions. So 100,000 million is I don't know, 100 billion. I don't know. Someone can do the math for me. These are on in millions. Okay. Um, so this you can see is low. This you can see is very high. Additional paid-in capital. We're going to see how these two accounts are related in a second. Okay. What is 100,000 times a million? 100 billion. Yeah. So, which is a totally arbitrary number. Okay. There's 100 billion shares authorized. There's 10.827 billion shares outstanding. Okay. So, as of December 31st, 2025. So, here's a little math. Okay. This is key concepts. So everyone pay attention to this. I think this is an easy one to misunderstand. You have this many shares that are outstanding that investors own. If you looked on December 31st, 2025, or the last trading day before that, because it's a holiday, the price per share was $230.82 per share. This price per share times 10.827 billion is $2.47 trillion. So this essentially represents the total market capitalization of Amazon. Okay. The price per share times the number of shares outstanding. Does that conceptually make sense? Right? So this is what the market is saying that the equity, the stockholders' equity is worth. Okay. So now if we look at the balance sheet, it's only 411 billion. So what is accounting for this difference? The stock market is saying Stockholder equity is worth 2.47 trillion. The balance sheet, which includes retained earnings, all the contributed capital, it's only 411 billion. Why is there such a massive difference? Well, this is the accounting value of equity, right? So if you just look at the transactions and the revenue and the expenses and you're adding all the retained earnings, the company's earned 250 billion over its life, right? So it's all you could argue this is kind of the net worth from the actual transactions that have happened in the business. So why is the market so far off from that? What else is it including?
I'm not sure, price per share is a market or it's far a while ago.
It's a market value. If you looked on the Google Finance, it would be that price per share. That's how much you would buy it for if you went to your brokerage account.
So this number should represent the numbers when the shares were issued, which would be different number. It's
True.
not gonna be equal to market value.
That's part of it.
So into their accounting and not adjusting for market value to like be raised, so.
That's true. Okay, good point. So one point is maybe I took $100 at the beginning of my company when I first started, and then I never took a single dollar of paid in capital or contributed capital. My businesses grew from there. But then you would see that, well, I've only earned 250 billion total. Okay, so how about this? I gave you guys the story of Instagram, right? Before they had any revenue, they were bought for $1 billion. So their stockholders' equity section of their balance sheet would have been a negative, retained earnings would have been negative. Yet it got bought for a billion. And maybe their stockholder equity would have said $10 million. So why was there such a big gap between what Facebook paid and what the accounting balance sheet showed? Yeah. Yeah, goodwill. All Amazon has all these technologies that uh, aren't really. They have kind of like a huge market leading kind of market share of e-commerce. All these things are intangibles. Okay, the market is also pricing in future growth. The market is also pricing in the fact that if you looked at their income statement, the income, the net income is lower because they spend so much on R&D and all these other things for future growth. So they're like, well, if Amazon really wanted to, they could cut their costs and increase their retained earnings by much more by being far more profitable. So the market is looking at the business in totality, not just what's on the accounting statements and coming to a value. And a lot of it is, of course, hype, The stock market just hypes up certain companies too. So you could argue that 2.47 trillion is too high. That could be your opinion as an investor. After looking at the book value, after looking at the income statement, you're like, actually, it should only be worth, yes, more than the book value, which is what this 4.11 billion is, but maybe it should only be 1 trillion. Okay, so this is the difficulty of being an investor, that you have the market giving you some valuation, you have the financial statements giving you some idea of what the company's worth, and your job, this is what people in investment management, that's why they get paid the big bucks, is it's very difficult to do, to figure out what is actually the fair value of Amazon. Okay, most most investment managers are actually like follow the herd. Okay, a lot of it is just following the consensus because the market, this $230 a share is a consensus view. Oftentimes, the consensus view is mostly right, but in order for you to be successful as an investor, you have to figure out when the consensus is wrong, and that's very, very difficult to do consistently. Okay, so $230 is not necessarily the right value for Amazon. It is just the consensus view of those who price this stock. Now, if you have a different opinion, you have to be firm in that conviction because you're having a different view on it than a lot of high paid people that look at the stock and understand it. Okay. So again, this would be your job as as an analyst. Yeah.
What are the different, like two numbers for common stock? 11,108, 11,000 to
Yeah.
6, and the same for shares outstanding.
So remember, there's a difference between issued, right? This is the number of shares that were sold, but they've bought back some. They've bought back uh,
two numbers.
for the prior 2 years. There's 2 years of information. Yeah. Okay, so is everyone clear on the difference between book value and market capitalization, market cap as it's called? Market cap is including all the intangible factors that investors will see in the business and ascribe a value to. There are some companies that trade very close to book value, like Berkshire Hathaway. That is there's a range that it trades between, like 1.2 to 1.7 times book value. Okay, Amazon is what? Uh, Not quite 10, 5x book value, right? 6x, 5 to 6x book value. Okay. So, but there are some companies, again, that just the nature of the business, there's not so many intangibles. The book value and the market capitalization follow each other much more closely. And there are some companies that trade under book value. Their market capitalization is less than their book value. So the investors are basically saying the financial statements are overstating the value of equity. Okay, so you'll find all these scenarios within publicly traded companies. Okay, but again, your job is to use the financial statements, use some signal from what the market value is, and figure out what the right value is. Okay, and it's a very difficult job. It takes expertise, it takes understanding of the business, the industry, um, many things to get good at it. Sometimes it's so blatantly wrong, though. You don't have to know much. Like when COVID first started, there's just a sell-off in everything, even the companies that were totally unaffected by COVID. So in those times, you as a lay person can take advantage too if you're not scared. Yeah.
I was getting the price per share is from like mostly based on the consensus view of the people that purchase those shares. Like, how does that not lead to issues in the stock market? It's like completely
Like if everyone's wrong.
maybe not if everyone's wrong, but like if um I guess because that makes it seem like a very subjective thing, and it's kind of up to like whoever is like the best at it, like the most professional in that specific area when it comes to pricing them. Um,
But there's many hundreds and thousands of people that are participating in setting that $230 price. It's not just like five people. There's thousands of people that are looking at Amazon stock and know it very well, like professional investment managers. So yes, in some respects, the size of the fund matters. But I think there's like, especially for these huge companies, there's there's a lot of eyes looking at it. It's not like there's like two people determining what it is. Yeah. There are actually for some smaller companies that could be the case where you have very few hedge funds that are like trading in that stock that kind of set the price for it. So that could happen, but I think for these mega large companies, that's very difficult to do. You need so much money to manipulate the price that it's like for Amazon and these level companies, it's not possible.
okay, thank you.
Okay, any other questions? Okay. Okay, so we're gonna see this again. The point of this slide was just to again emphasize the difference between book value and market cap. So I'm hoping that you all understand that very crucial difference. Okay, they're again related, but oftentimes diverge. Okay, so in the issuance of stock, we've seen this. The company is going to give up ownership and it's going to get some assets, usually cash. Um, Companies issue stock because they want to pay for things, they want to pay for growth, they need working capital, so just money to pay the salaries and stuff. You can argue that the stock-based compensation for employees, instead of giving them stock directly, you can sell stock to the market, get the cash, and then pay your employees that cash, right? That's another way of potentially paying your employees this compensation. Now, it doesn't solve this principal agent problems. You want the employees to hold the stock because they have an incentive for it to go up by performing well at their jobs. But really, it's like, corporate needs to pay employees is one reason why they may issue shares to raise capital for all just like the day-to-day expenses, the working capital that they need to finance the business. Um, I guess just a word on the mechanics. You have uh, these entities called underwriters. They're basically the investment banks. What they're going to do is help the company link to the capital. They're like a broker. They're a middle person. The company, uh, whatever, SpaceX goes to Goldman Sachs and says, "Hey, we need to build this rocket factory. We need $50 billion." Goldman Sachs will say, "Hey, we can raise 30 through the debt market, and we can raise 20 through selling shares," and they will help SpaceX do that. They'll work in the bond market, find investors to place that bond and raise that 30 million. They'll also find equity investors to buy that 20 billion in equity. Okay. And so the investment bank not only will help market it, they will oftentimes also guarantee a certain price for the shares of stock, or guarantee that the capital will get raised because they will put up the money that they can't raise from other investors. Okay, so the company benefits because they get the guarantee that the money will be there. Okay, um, yeah.
Investment banks buy and pay for the shares first and own them and distribute.
So
It just the third party that
it depends. Okay, if the company wants a guarantee that they will raise the money, since Goldman Sachs, these companies have a large balance sheet, they can actually give the money to the company.
for the share.
But what the investment bank wants, they're not an investment vehicle where they want to own shares long term. They will temporarily fund that and they'll try to sell it as soon as they can. Sometimes they'll be like, "Well, we're not sure we can sell all the shares, so we'll do our best effort. We're not going to guarantee anything."
They are not buying,
Yeah, they will just take
selling without
yes,
money.
they will just try to market the shares, and whatever shortfall there is, the company will have to just deal with it. Yeah. But of course, if they commit, they're going to take more fees, right? If they say, "We're definitely going to guarantee you that this money will be there," their fees will be higher. There are now some companies that say, "Screw the investment banks. I don't want to pay their fees. They don't even do a good job of marketing my IPO. I just will sell directly to the market." And this is possible. Like the NASDAQ stock exchange, it allows this much more easy company access to the market because it's all electronic trading and whatever. They have some technology that kind of makes this possible. But this has also been failed. There's some uh, stories where this failed too, because the investment banks do a good job of getting people riled up to buy the shares. So there is a value add that they do have. Okay, and then where do you go to buy shares? Um, there are stock exchanges. Okay, so this is where um, you can go to buy the shares of your company. The New York Stock Exchange, NASDAQ, These are the two main ones in America. New York Stock Exchange is typically like um, non-tech company. A lot of tech companies are on the Nasdaq, like biotech, uh, information tech. But NYC is like banks, oil and gas. It's got more of the traditional companies that are listed on the New York Stock Exchange. The LSE is the London Stock Exchange. Um, Tokyo Stock Exchange, Euronext is the big one in Europe. Shanghai Stock Exchange. So there's many, companies will list their shares on these various exchanges. And these benefit from network effect. Okay, once you have a large exchange, it's going to attract people to list on your exchange. So it's hard to displace these kind of incumbent exchanges because they have large networks built up. Okay. Okay. So let's just cover this next little section and then we'll take a little break. Okay. So par value of stock, as we saw in Amazon, um, before there was regulation in the capital markets, it was like kind of the Wild West. Okay. You had people in America, for the railroads and stuff, selling shares. Um, and there was a common scam where uh, someone would sell stock to investors for $1, and then and then those people would think they own some percentage of the company, and then the scammer would just like basically for insiders and like whoever give shares for a much lower price to other people. Okay, and that would dilute those people that paid $1. And if you sold that same share for 1 cent to someone else, then that person got the same percentage ownership for 1/100th of the price, right? So uh, one way that uh, companies gave assurance to their investors is they guaranteed a minimum price for the stock. And this is what the par value historically came from. It was not like regulated. It was just a way for the companies to gain the trust of investors by saying that we will never sell our stock for under X price. And that X price was the par value of the stock. Okay. So now it's totally irrelevant. Okay. We don't have these scams because it's such a regular issuing shares now is a highly regulated uh, thing. Okay. All the companies that you can invest in, the reason why the government allows them to sell to all of us, the public, is because they're so heavily regulated. Okay. There's so many government officials watching what they do that it's hard for them to run a scam. There are smaller private corporations that do not allow those companies to sell to everyday people. Okay. They can only sell to people that have $1 million net worth, they're sophisticated, there's all these requirements. Okay. Um, but if a company is publicly traded, they're the most heavily regulated because the scam, there's a history of scammers. Okay. Um, which is, you can argue that it's not quite fair because a lot of the private investments are where the returns are much higher. So, and it's only accessible by rich people, you know? So, it's still a little unfair, but it is what it is. It's the government trying to protect people from being scammed because the default, as an aside, political philosophy here, our current system of government assumes people are dumb. Now, is that the correct assumption? You guys be the judge. The government has set up so many things that are there to protect you. Now, are you capable of protecting yourself and being a discerning person in all the things? Consumer goods, right? We have so much regulation on the goods and services that we buy, right? You can't buy a washing machine now that has like analog stuff because the water use regulation, So are people too dumb to figure out what's in their best interest, or do we need government to do it? This is a philosophical question that we all can vote on and decide, you know? Um, but the current system is highly regulated, so you don't really need par value. It's kind of a done system now.
even need par value, but is it still stands?
Yes.
So cheaper than $1.
Yes, you can. But
Company goes as a contract and their shares all below.
you saw that Amazon's par value is 1 cent a share. So that's now how it is. They keep it at 1 cent or even a fraction of a cent, 0.001 cents. But the legal, how the corporate law, because the laws are all old. Some states require you to have a par value, but the companies now just get around it by having some very low, trivial par value. Okay, so the only thing that really changes is we now have an extra journal entry line item. Okay, so you can see here, what is going on with this? You can see here that this common stock, $1 par value, 3,000 shares. Um, you're gonna basically take the number of shares times the par value and have this, and then all the remainder of however much money you raised is going to go into this paid in capital in excess of par. Okay, so again, in this transaction, y- the high level is that you sold 3,000 shares for $4 a share. Okay, so you know that you raised $12,000 total. That's easy. Price per share times the number of shares. Now, what this is going to be dependent on the par value. What would this be if my par value is 1 cent? What would this have been? Exactly, $30, because it's 3,000 times 1 cent. Okay, so this would have been 30, and then what would this have been? Yeah, 11,970. Okay, is everyone good with this? Okay, so quite trivial, I think, but it is what it is. The system still exists, so you should know it. So you can see here, 1 cent par value, and they issued basically it's this number times 1 cent is how they got this. Okay, all the rest is in this paid in capital because obviously Amazon stock is trading for much higher than 1 cent. Right, so all the additional paid in capital is in this account. Yeah. 1 cent's literally the definition of a penny stock. Exactly. Yeah, exactly. So these two will be correlated: the par value and the no, the balance in that account. Okay, everyone see this? Everyone good? Okay. Okay, so there are some, no par value stock. It makes then the journal entry is exactly as how we've been doing it. Okay, you don't have to worry about that extra line item. Yeah.
One statement, we don't have an option to have no par value stocks. So how you would report common stock if you had both? Or it's not possible. If company decides to go no par value, then they will have only that.
Yes.
There's no.
Yeah, you won't have both.
Oh,
Yeah, you won't have both. Okay. And then just another uh, example here, if we exchange stock for an asset, um, you'll either need to know the market value of the shares. So in this case, the transaction is this. We're giving 4,000 shares for this furniture. Okay. Now, if you had a public company doing this, and let's say the market value was $10 a share, you would basically you're either going to know the market value of the furniture or you're going to know the market value of the shares. Okay, that's going to determine what you're going to value this transaction at. Now, which one is more determinable? Like if it's your small little startup, it's probably the market value of the furniture because the furniture you're going to go to some store and buy it, so you'll know what it's worth. Okay. If it's just like artwork or something and you're trading your Amazon stock for art, then the Amazon stock is more determinable. If you're giving 100 shares of Amazon stock for this artwork, you'll be able to price this transaction based on the value of the shares because just do 100 times $250, and you have the value of the art. So the value of this transaction, again, will be determined by either the value of the shares or the value of the furniture, whichever is easier to determine and more conclusive. That makes sense? Okay. Okay, and then let's just talk about preferred stock, and then take a break and we'll do a practice problem. Okay, so preferred stock. Okay, um, it is here's our liabilities plus equity. Okay, now the safest, highest seniority, as we call it, piece, is your liabilities. Okay, between these two, the liabilities are always senior, and within liabilities, there's even a tiering. So the senior debt, this is the safest uh, part of the balance sheet. It's going to be first to pay. So whatever happens to the company, if they start off with like $100 worth of assets, um, if they go down to $50 worth of assets because they take losses, and you had $20 of senior debt, they're going to get paid first of that loss. Okay, that $50 that remains, the first money out is going to go to the senior debt. If there's any left, it goes next to this subordinated debt. And then your trade liabilities is like your accounts payable. Okay. So there's an order here of, if things go badly, who's going to have first feeding of the trough. Okay. And the most senior debt holders, they have structured their loan and or the bond or whatever it is to have first recourse to the company's assets. So once the liabilities are all satisfied, even within equity, there is preferred stock, which has a higher preference or priority than common stock. Common stock is just the leftovers. Whatever is left over is going to go to the common. And that could work out because all these people have a fixed amount of return. So if the company does extraordinarily well, all the benefit will accrue to these people. But they're also the first to take any losses. Okay? So this concept of seniority is also really important in corporate finance. And who is senior to who, especially when things go badly in the company. Like, this is what happens in bankruptcy court. All these people fight with each other to go over the scraps. And oftentimes what will happen is that these people will get wiped out. They'll get nothing. These people will get maybe a very little. And then these people will take over as the equity owners. They'll just become the owners. Their debt will turn into ownership. Okay. Okay. Now a preferred return. So the pref is a preferred return. It's similar to the interest payments on a bond, but it's not exactly the same. A bond or a loan is a liability. If a company misses those payments, the bond holder or the lender is going to get very mad and they're going to take legal action. If you're a preferred shareholder and your pref gets missed, you can't really do anything. Okay, you're gonna wait around. Okay, so the preferred return, as it's called, is similar in that it's usually gonna be some percentage, like 5%. It's stated similarly to how a coupon for a bond is, but it's legally not the same because the company can skip that pref and still be okay and not be in bankruptcy. Okay, so this is why a preferred shareholder is junior to a bondholder. They don't have the same rights. They don't have the same guarantee of a payment. Okay, there are also two different types of preferred stock: cumulative preferred and non-cumulative. Cumulative is if the company misses that coupon payment to the preferred stockholder, it accrues. It's not like the company can get away with it. Once they have the cash, they have to pay for the back payments plus the current ones. There is non-cumulative preferred stock where if a company misses the payment, move on. Okay, that money is gone. So which one is more valuable? Which one would you rather have, cumulative or non-cumulative? Who votes cumulative? Yes, the cumulative is, uh, you're entitled to more payment. Okay, so yes, all else equal, you'd rather have the cumulative. Okay, so it's very similar to how common stock is issued, cash in. The preferred stock is going to have some par value. This par value is actually important because the coupon is going to be like, 3%, but it's 3% of the par value. Okay, so just like in a bond, the coupon is paid as a percentage of the par value. It's the same with preferred stock. Okay, so in this case, we issued 1,000 shares of $50 par value stock. It has an 8%, you can think of it as a coupon, and it's issued at $55 a share. So that's how we got this 55,000. 50,000 is going to be recorded at par value, and then just like common stock had to paid in capital in excess of par, we have this paid in capital in excess of par for preferred. Okay? Okay, and then you can see how this is all going to get arranged in the balance sheet. Paid in capital, you can have preferred, you can have your common, and you're going to have, and again, these are recorded at the par value. Then you have these two for all the capital that was paid in excess of par. Then you have retained earnings, and then you have your total. Okay? Okay. So let's maybe take a couple minutes. I want to try to at least start the next section. So let's go take a break till 2:08 and then do this example. And then I want to kind of start the next section too. So take a little break. You can download the Excel sheet uh, and we'll be working on practice problem. Okay, so let's do this together. So the first one, 2,000 shares, and we're selling them for $9.50 per share. So immediately I can figure out how much cash I'm going to collect by just doing $9.50 times 2,000 shares. So I'm going to be bringing in $19,000. Now before we would just do common stock, 19,000. This was the level 1 journal entry. But now we're introducing this idea of common stock, $1 par value. Okay. And this is going to be the number of shares, 2,000, times the par value, which is $1. And then all the remaining kind of capital that was contributed is going to be in this paid in capital in excess of par for common. Okay. Any questions on this? Yeah. Yeah, because again, this common stock par value is going to depend on the par value, right? In this case, it was $1, right? If it was 1 cent, I would have done this 2,000 times 1 cent, and then that would have changed how much is in here. If it was $2 par value stock, so it's all going to depend on what the par value of the shares are, and then all the remainder will go into paid in capital in excess of par. Make sense? Okay. Okay, so the next one is issued 300 shares of $3, no par value preferred stock for $15,000. Okay, so I already know I'm bringing in $15,000 cash, and we don't have to do the par value and this paid in capital in excess of par because This is no par value preferred stock. So we're just going to be able to do preferred stock, 15,000. Okay, so that one is simple because there's no par value. Okay, and then this last one, received equipment with the market value of 78,000 exchanged for 3,000 shares of $1 par value common stock. So 78,000 is the total value. We're getting equipment. We're going to have basically these two same. And it's for 3,000 shares. It's going to be 3,000. And then the paid in capital in excess is just 78,000 minus 3,000. Okay, so everyone good with this? Makes sense? Yeah. Yeah, so this is gonna probably have to do with like like how much of preferred return is gonna be paid. It's not relevant here because it's not really mentioning anything about the preferred return. Yeah. Okay, and then how much paid in capital these transactions generate? Well, it's how should we do it? What's the answer to this? How much total paid in capital? Well, it's just the sum of these three. Okay, so it's 112,000. It's just equal to the sum of this and this and this. That's the total capital that we've raised from our investors. And some of it was cash, some of it was equipment, but that's the total capital contributed. Make sense? Yes? Any questions? Any last questions? Okay, all right, so let's move on. Okay, so treasury stock. So this is related to this topic of stock buybacks, okay? Where a company is going to go to the market and kind of like retiring a bond early, right? We talked about this in chapter 12, where the company goes to the market, buys their own bonds back, and then they don't have to pay the bonds, right? They kind of retire them early. So this is similarly a transaction, but instead of a liability like a bond, it's buying back their own stock. Okay, so why would a company do this? Um, for one, as we talked about, uh, the more shares you have outstanding, the more slices they get to cut your pie into of profit. So if you take shares off the market, you're going to have this anti-dilutive effect. Okay, so for example, if you had $100 of net income and you had 10 shares, that means that you split this $100 into 10 slices, and each slice is $10 per share. But if you reduce this to 8 shares, what is it now? Is this going to go, is it more or less than 10? It's 10 point something. It's higher, okay? Because you have less slices. You have the same $100 in net income, but you're splitting it over less number of shares. So each share is going to get more portion of that net income. Okay, so this is what we call anti-dilutive. Okay, oftentimes companies are issuing more shares. It's going to go from 10 to 12 to 15. So you have to share. But you're hoping when you do this, when you increase their share count, this $100 is going to go up to 200 to whatever. You're growing your business, right? When you issue new shares, you're taking in capital, you're building more factories, expanding into new markets. So you're hoping that the dilution by issuing new shares is offset by an increase in net income. Okay, if you're issuing shares and your net income increases, but the proportion, the earnings per share doesn't increase, then you're just running on a treadmill. There's no reason to even grow. Okay, so you're hoping that your investments are going to increase your return as an equity holder. You as a existing shareholder are not really happy um, where your business expands and generates more revenue, but your earnings per share is not expanding. Now, the CEO, again, this is a big principal agent problem. The CEO of a company is happy to do that. Why are they happy to do that? Why would a CEO of a company expand the business even though it wasn't growing earnings per share? What is their incentive? What do you think? Yeah, Mohammed, what do you think?
Maybe because if they expand, they would like raise capital to say something so like having its
They get more what? What was the last thing you said?
cash money.
Yeah, they get more cash, but it's not really like the shareholders are not necessarily benefiting because their slice of the pie is not growing from that company growth. But why is the CEO benefiting? Yeah, what do you think?
To increase his influence to show off.
Exactly. That's a huge part of it because you're running now instead of a $1 billion company, you're running a $10 billion company, right? So though it's not accretive, as we say, to the shareholder, the CEO is benefiting because they're running a bigger, their little kingdom is bigger. Okay. So this again is a big, uh, this is like mergers and acquisitions. There are so many CEOs that will just look for mergers to buy other companies. And it's not necessarily in the best interest of the shareholder, but the CEO benefits because their kingdom is bigger, you know? It's like a, what is it? Imperialism. Okay. These countries will go out and try to conquer territories. They can't exactly hold them and like profit from them, but their territory is expanded. So they have more clout. Okay, so this is the same thing with companies and CEOs. So it's very rare for companies to have very shareholder minded managers. And there's certain companies that have a culture that's built around that. They will not do acquisitions or expand the business unless it's accretive to the shareholders. And you want to find those companies and invest in them because then you're gonna you're not just the play money of the CEO who's trying to expand their empire. They're actually trying to create value for you, and um, that's kind of rare in the corporate world, unfortunately. Okay. Um, okay. So creates short-term demand for the company stock. So just a company going to the stock market and buying their own shares, it's all supply and demand driven. That's what is in the short term determining the price per share. So it's a support for the shares, okay, to just create demand for it. Um, it also avoids takeovers, okay. So if there is some activist shareholder that's trying to go to the market to buy a stake in your company so that they can put someone on the board and kind of take over the company, by the company buying its own shares back, there's less available for a hostile investor to buy. So some companies will burn money buying their own stock just to prevent, again, this is a CEO trying to protect their job or whatever, right? Because if an activist investor comes in, maybe the CEO is going to get fired. Okay. So some CEOs and managers will sacrifice the shareholder and their capital to just protect their job. Okay. So this is this is another one. Um, it's more tax efficient for shareholders as a means of returning capital. Now, this is not always the case. Sometimes the investors just want cash in their hand, especially if the stock is overpriced. Okay, if the company is giving cash, returning cash by just buying back stock, the existing shareholders would probably rather have the cash in their hands because the company is essentially overpaying for the shares. Okay, so this one is it depends on what's going on. The specifics and the context matter. Okay, so how are the treasury stock transactions accounted for? Well, the company's going to pay cash, right? Because it's like they're going out and purchasing the shares. So you're going to credit cash, and we're going to have this new account called treasury stock. Okay, this is going to be a contra equity account because it's going to be a debit normal. Okay, we know that our other equity accounts are credit normal, but this treasury stock account is a contra account. It's contra. Sorry, I guess here contra account. The value of the stock is recorded at cost. So we're going to see, and there's no reference to par value. So in this contra account, treasury stock, the par value doesn't matter. It's just what we're paying for it. The balance of this is recorded underneath retained earnings and is a reduction of equity. Okay, but again, since it's a contra account. If the shares are sold later, because once you buy the shares, you could reissue them. Okay, and we'll do some sample transactions to see this. Okay, but the key thing to remember is that this treasury stock account is always going to be accounted for at your cost. Okay, and again, I'll show you that with some examples. Okay, so the retirement of stock is treasury stock, which is canceled and cannot be resold or reissued. So how this affects issued and outstanding, I didn't get a chance to look that up, but maybe next class I will look it up and tell you all. But if you retire stock, then you're not going to ever reissue it. Okay. Okay, so I think let's look at some transactions, and I think that will hopefully answer some questions that you may have. So save your questions for a little bit. So on March 31st, we purchased 1,000 shares from the market, and we're paying $5 per share. Okay, so we are going to credit cash 5,000. Again, 1,000 shares. We're paying $5 per share, and we're going to debit this treasury stock account, which again is an equity account, but it's a contra account, which is why it's debit normal. So now let's say we resell. So we have 1,000 shares now in our treasury stock account. We're going to resell 200 of those, and we're going to get $6 a share. So did we do good? What do you think? Is our company benefiting from this so far? Why? Mohammed, you gave me a thumbs up. Why?
Because then the price of the share has gone up.
Exactly. This is buy low, sell high. You bought for $5, you're selling for $6. Okay. So you're going to receive cash because you're selling those shares back to the market. This is the key accounting weird thing. Okay. This treasury stock account, you're always going to use your historical cost of $5. So this 200 shares at $5, you're going to kind of reduce the balance by those 200 shares at its historical cost. And this gain, you can say, this $200 gain is going to be in this account, paid in capital from treasury stock transaction. This is basically, it's like a revenue. Okay. This is going to increase the value of our shareholder equity. Because as we said, we bought low and we sold high. So that's kind of like a profit that we just made. So that's going to benefit the shareholders. That extra profit is increasing my shareholder equity. Okay, but we're going to put it in this account called paid in capital from treasury stock transaction. Okay, so is everyone good with this? Yeah, any questions? Anything to clarify? No? Okay, so the T accounts, again, we started with 1,000 shares. This is $5, $5, right? This 5 times 200 is 1,000. And so now this balance here is 800 shares because we had 1,000, we sold 200, and so we have 800 left. And again, this is always accounted for at the historical cost. And now we have a $200 balance here in this paid in capital from treasury stock transaction. Okay, so now we resell 250 more shares because remember we had 1,000. We resold 200, so we have 800, and now we're gonna resell 250 more. Okay, so we're gonna get cash again. Again, we're always going to account for this at historical cost. So $5 a share, 250 shares. And you can see here to make the journal entry balance, we need a debit instead of a credit. And what we're going to do is this is kind of like a loss, right? We bought for 5, we're selling for a lower price now. So we took a little loss. But we are only going to take it away from this piggy bank that we have already set up here. We had that gain. We're going to now kind of take away from that a little bit. We're going to reduce that from this next loss transaction. Okay. And again, this is always, in this one, it's always going to be at $5 per share. Is everyone clear on that? Yeah? Yeah.
So if you decided to buy Treasury stock again at different market price, you'll have to account.
Yes, I'll show that at the end. Yeah. Okay. So now we resell another 300. So at this point, again, we have 550. We're selling another 300. We're going to get $1,200 in cash, which is 4 times 300. We're going to account for this again, always at $5 a share. So this is $5 times 300. Now, this is a little tricky, okay? In this account, we only have a piggy bank of $125. We can only debit this 125 to make it 0. Okay, so once we do that, we still see we have a loss to make this account balance because, again, we bought for 5, we're selling for 4, we took a pretty big loss here. So we're going to reduce this to 0 here. And then the rest of the loss, we're just going to take out directly from retained earnings. Okay, so you can see here how this all plays out. So in our treasury stock transaction, this is our original purchase. We had these 3 sales transactions. I think this first one was at $6. This one was for $4.70, and this one was for $4. Okay, we've zeroed this out because even though we had a gain from the $6 one, our subsequent 2 transactions we had losses. This is zeroed out, and then we still even had to dip into retained earnings and reduce this. So far this has kind of been a bonehead kind of plan that we've been doing. We've taken a loss. We've reduced our retained earnings because of this. Okay? We don't know how it's going to play out. We still have these 250 shares. Maybe they're going to go back up and we'll make up even for this loss, but who knows? But so far we're kind of losing. Okay? And then last transaction, let's say we buy more shares. But now it's at a different cost basis, $3.90. So we have a new entry into treasury stock. We have the cash going out. And now what we have is it's kind of like inventory. We have 2 layers, right? We had these original all were transacting at $5. We now have this new layer coming in. And so this balance is made up of 750 shares, but at 2 different cost bases. So when we now do subsequent transactions, we'll have to determine from what lot these are coming from. Are we selling these $5 shares? Are we selling these $3.90 shares? And that will determine whether we have a gain or loss, right? Because if we sell it for $4, we would have a gain if we were using these shares. We would have a loss if we were doing these shares. Okay, so we'll have to kind of like inventory, like we learned in chapter 6. This is like specific identification. You'll have to use that method to kind of account for it going forward. Okay? Okay, so we have 10 minutes left. Let me think. What should we do? Maybe we can save the